Hey everyone, welcome back to Corporate Decoder. Today we're diving into a filing from Senseonics, a company that makes glucose monitoring systems, and let me tell you, after looking at these numbers, it seems like Senseonics might need to monitor its own financial health a little more closely. I'm joking, of course, but you will see what I mean in a bit. Before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come and join. This is a Form 8K, which companies file to announce major events. In this case, Senseonics is telling us about a big move to raise money. Scroll item 1.01, entry into a material definitive agreement. Scroll to the main event is that Senseonics has entered into an agreement with underwriters, basically banks, to sell a whole bunch of its stock. They're planning to sell 100 million shares of their common stock at a price of $0.50 per share. That's 50 cents a share. It's like they're having a half price sale on their company. And the banks involved have the option to buy even more shares, up to 15 million more. The net proceeds to the Coffin Company from the offering are expected to be approximately $45,400 scroll after paying the banks their fees and other expenses. Senseonics expects to get around $45.4 million from this stock sale, or about $52.45 million if the banks buy all those extra shares. All of the shares are being sold by the company itself. The deal is expected to close soon, around May of 2025, if everything goes as planned. Scroll. The securities described above are offered and will be issued pursuant to an effective shelf registration statement for. They are able to do this because they have a shelf registration, which is like having a pre-approval from the SEC to sell shares when they need to. Scroll. The underwriting agreement contains customary representations, warranties, and agreements by the company. Scroll. The agreement with the banks has all the usual promises and guarantees you'd expect. Senseonics is promising that their business is what they say it is, and both sides agree to protect each other from certain risks. If you want to read the full legal details, the agreement itself is filed as an exhibit to this report. Senseonics also put out a press release to announce the stock sale to the public scroll that the company had commenced the offering, and on May 15, 2025, the company issued a press release. Scroll actually issued two press releases on the same day, one saying they were starting the offering and another saying they had set the price. Scroll. Current report on Form 8K contains forward-looking statements. Scroll. TEV. Now, Senseonics includes some legal language called forward-looking statements. This is where they remind everyone that they can't guarantee the future. They're making predictions about how much money they'll raise and when the deal will close, but things could change. Scroll. The uncertainties related to market conditions and the completion of ATI on ATI-faded terms or at all. Scroll. They mention risks like changes in the market and the possibility that the stock sale might not even happen. Scroll. Annual report on Form 10K for the year ended December 31, 2024. Scroll. If you want to know more about the risks Senseonics faces, they point you to their annual report and other filings with the SEC. They also say they're not promising to update these predictions, even if new information comes out. And that's it for the main part of the filing. It's signed by the Chief Financial Officer, Rick Sullivan, to show that it's official. Now, let's take a step back and discuss what all this means. Here's the story. Senseonics needs money, and they're getting it by selling a ton of stock at a very low price. This is called a dilutive offering because it waters down the value of existing shares. Think of it like adding water to juice. You get more volume, but the flavor isn't as strong. So why is the Senseonics doing this? Well, it usually means they need cash to fund their operations, pay off debt, or invest in growth, but it also suggests they might not have a lot of other options. What are the good points they are getting the money they need? At least for now. They're also being upfront about the risks involved. What are the bad points? Selling stock at such a low price isn't great for current investors. It could signal that the company is struggling or that they don't expect the stock price to go up anytime soon. This heavy reliance on capital infusions to fund operations is a bad sign. It means that their underlying business model is not profitable. It is important to look at the numbers and not let yourself be bluffed by marketing. Ficht now, for my take on Senseonics. Direction. It seems like Senseonics is at a crossroads. They have a promising technology, but they're facing financial challenges. They have been losing money. Risks. The biggest risk is whether they can turn their technology into a profitable business. They also need to manage their debt and avoid running out of cash again. Opportunities. The market for glucose monitoring is growing, so there's definitely potential for Senseonics to succeed. But they need to execute their strategy well and convince investors that they can generate profits. In conclusion, this stock offering is a temporary fix for Senseonics' financial problems. The long-term success will depend on whether they can improve their business model and achieve profitability. It is a wait-and-see type of situation. Alright, that's our breakdown of Senseonics' latest filing. What's your take on these moves and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.